So flipping over to the carbon flat roll side of things, we've looked at this chart many times in the past. Ultimately, the most recent rally 2-3 months ago really kind of started within the European region because as we've noted, Europe's got a much closer geographical footprint to Russia, Ukraine. As the invasion began, there was a fairly large panic within the European region for steel products, whether it was scrap, whether it was iron ore, coking coal. And you can see that here in this chart. The blue line is going to be your European steel prices. It really led the US rally. So a couple weeks later, the US market, which was trading down around $1,000 a ton on the hot roll contract, traded up about $500 or $600 very, very quickly. You can see that here in the white line, which is basically just a straight vertical. Since then, I will admit that we have had a little bit of that panic subside. So Europe has found other sources, in part from China, who is obviously in a very, very swift lockdown, slowdown situation right now. So Europe has been able to find some replacement substitute sources. So you can see in both the European situation as well as the US situation, we are beginning to see carbon sheet markets drift back lower a little bit. Additionally, what we're looking at here is going to be the busheling scrap price in the blue versus iron ore in white. Both have kind of rolled over a little bit. Iron ore not too much, which is actually kind of surprising given the fact that China is basically in half the country is in lockdown right now. So it hasn't moved lower by a massive amount, but certainly coming off the high levels is scrap. Brent mentioned it briefly, but we are expecting to see probably a $50 to $75 move lower in the price of scrap. So all things being equal, that should make it a little easier for steel mills, particularly electric arc furnaces, to produce steel profitably at slightly lower prices. But if Brent's commentary was any indication, steel markets really across flat and long products are still extremely tight. So, what normally may have been a $250 to $300 spread between scrap and steel, you probably got to widen that out by a fair margin just because markets are still pretty tight within North America. And interestingly, within the futures space, we've looked at this chart many times over, but the blue line is going to be the steel futures curve, the hot roll coil steel futures curve, as of 6 months ago in the blue, a month ago in green, and then the current pricing is shown in orange. Really, it may not look like a whole lot because directionally they're all kind of pointing a similar trend, but you look at the gaps between some of those prices along different spots on the curve, and you're talking $200-300 moves. So basically in the last month, we've seen steel futures drop by about $300 on various parts of the futures curve. We are admittedly beginning to see some customers step back into the market and do some hedging so that they can lock up their prices. It's kind of a little quick commercial, not a suggestion or anything, but we do have the ability to lock in futures prices so that we can give our customers fixed prices on steel. And a lot of the downward trajectory that's currently expected in the market is basically priced in. It's being priced into the future space already. But yeah, it's been pretty fascinating that over the last 3-4 months, we've seen a pretty swift roller coaster of prices coming down sharply, going up sharply, coming back down. Unfortunately, this volatility that we're seeing within metals and more broadly commodities seems like it's going to be with us for a little while as we sort through the supply-demand balances.